The legendary investor Warren Buffett bought his first stock at age 11. At age 11, I spent most of my time playing sports and video games, but to my credit, I was saving about 90% of my weekly pocket money because my dad gave me a sweet deal. The deal was that every 6 months he would double the total I was able to save over that period. And so you could see this as me investing at age 11. Only my interest earned over 6 months was 100%. And it's sad to say that I haven't seen those type of returns in years. If you're new here, welcome to our channel. My girlfriend and my aim is to create financial education videos and to create a community of money-minded people. The meaning behind the name is simple. Being money-minded is being interested in money, being good at getting it or saving it, and that's our goal, is to get you money-minded. Anyways, let's get back to Buffett and investing. Buffett experimented with the timing of buying and selling, charts, and all other things that are basically pointless in the long term, but was fun for him as a kid. He read countless books on investing and started doing what everyone else was doing. Looking at a chart and trying to figure out what would happen next. Then he read The Intelligent Investor by Benjamin Graham, which set his philosophical framework for investing, and these 3 simple rules I want to share with you today. So rule 1 is to visualize a stock as a piece of a business, and not to get caught up in the news, the new AI stock that's going to triple in value, or investing in the hype, aka momentum. In the game of buying low and selling high, understand that this stock is a piece of a company with employees running a business. In simple terms, you value the business and then divide this value by the number of shares issued. But what you have to think about is something called the fundamentals, which include things like what kind of business is it? And what industry is the business in? What are its competitive advantages? What's the management structure and performance like? Do you actually understand what the business's revenue model is, aka how it makes its money and how it hits its targets? It's a lost cause just knowing the ticker symbol on your brokerage site and thinking, that looks like a good buy. So understanding a business is super important. You want a business with a competitive advantage, and the technical term in the asset management world is called a moat. And very importantly, you don't want a competitive advantage that's only going to last a few years. You want a moat that's so deep and so wide that the enemy, aka the competitors, can't reach in order to weaken your defense and steal some of your riches. And this can be done in many ways, like through brand loyalty, cost leadership, which is having super competitive pricing, patents and trademarks, the size of the castle and where it is located, meaning better economies of scale, and very importantly, having experienced and reputable people managing the company. So if you enjoy the topic of investment and like what Warren Buffett has done for the industry, then hit that subscribe button, because we'll be talking a lot about investing in the next financial videos. Rule number 2 that Buffett took away from this book was how an investor should react to stock market fluctuations, aka their money psychology. Most people react the wrong way. They feel good when their stocks are going up and bad when they're going down, and they make decisions based on how they feel. As a beginner investor, you don't really have to pay much attention to the stock market prices, unless it's beneficial for you to do so. A simple rule of thumb would be to reanalyze your financial situation once a year, provided that you follow the 3 steps in this video. Because what's remarkable about stocks, if you think about it, is that if you look at the stocks that make up the S&P 500, you would see that the quality companies with strong moats have long-term upward trends and have been persistently in the top 500 for years, if not decades. And basically, that is what Graham is trying to say in his book. The stock market pricing isn't there to instruct you to do anything. It's there to serve you in the most powerful way possible, through compound interest over time. And as a beginner, it is highly advisable to invest in quality companies with strong, wide, and deep moats, and to do this over a long time frame. The 3rd rule is having a margin of safety. You don't cut things close in your daily life. For example, driving your car on empty and trying to maximize your travel distance in hopes it goes to plan. So why would you do that in the stock market? Remember, you are still accepting a level of risk when investing. So build in a margin of safety for yourself so that you're not so fearful when your stock does take a dip. So let's move on to the second part of the video on how to actually invest in the stock market for beginners. and I'm going to broadly explain the following: what stocks are, how to invest in stocks, how people get wealthy by investing in the stock market, and what stocks are best for beginners. So let's get started. I want you to know that the stock market is actually very simple when you're a beginner with limited knowledge. It's when you start diving deeper into it, getting qualifications and expertise in it, that the burden of knowledge starts playing a factor. So don't be in a rush to learn all there is to know, and don't be afraid to just start. So the stock market is a big marketplace where you exchange cash to buy and sell stocks. To participate in the stock market, you need an online brokerage account, and there's a lot of them to choose from. They will usually be free to sign up to, and some of the popular ones include Robinhood, Webull, and Interactive Brokers. Then you open up an account and transfer money from your bank account to your brokerage account, and then you're ready to start buying stocks. Just remember to do your research and follow the 3 rules we spoke about earlier and invest in quality companies. In simple terms, if the company performs well and grows, then the value of the company will increase. And if the value of the company increases, then the price of the stock will also go up. If the company is making a lot of profit, then they can choose to take some of that profit and pay a dividend to whoever owns that stock, which would be you. And the nice thing is, you don't have to do anything to collect the dividend. It just gets deposited into your brokerage account, which is pretty cool. And so this is passive income in its truest form. If you've invested in a quality company that's still growing and performing, you're earning unrealized money as the stock's valuation increases, coupled with realized money in the form of dividends. It's a win-win. If you do want to sell your stocks, it's very easy. Maybe something sudden has happened in your life and you need the money tied up in your investments. Or maybe you don't like the company anymore due to a change of management. Or you want to bank some profits in cash and realize some of the gains you've made. You're free to do as you please. From there, you can actually withdraw the money into your bank account. You could also leave the money in the brokerage account for an opportunity later down the line. Again, it's all up to you. So many people get wealthy from investing in the stock market through various methods, but many people also lose a lot of money through buying into the hype that later falls, or buying into a company that they don't really know how it works, or confusing trading with investing. And realistically, there are mainly 2 different approaches to investing: the active approach and the passive approach. Some people buy stocks and they just hold them for a very long time. I'm talking years, decades. Some people will even hold their stocks until they pass away and put it in their will. And so this is a set it and forget it approach. The other side of the extreme are people who buy and sell very frequently, trying to make quick money. And so these people are known as traders. Traders are not interested in holding a stock for the long run. They're not interested to see this company grow and follow its journey. And so as a beginner in the stock market, I would refrain from doing any short-term trading with large amounts of money, as it requires a lot of practice and luck in different market conditions. And always remember, only ever trade with an amount you're willing to lose 100% of. Speculators are people who buy smaller, often significantly riskier stocks that have the potential to skyrocket in value, but the likelihood of losing all their money is quite high. Some examples of speculation could be Tesla back in the day, or crypto in 2020. The things that these 2 had in common was that they were both new ideas that could potentially disrupt the market. But there's always 2 sides to the story. There's those that speculated and made lots of money, and those that speculated but didn't take any profits and ended up back at 0. So that is why investing for the long term, in strong companies with strong moats, diversifying your risk, and understanding who you are owning a share of, is the 3 vital rules Warren Buffett has learned and remains powerful in investing strategies today. So finally, let's look at the stocks that are most suitable for beginners, because there are so many stocks to choose from. Big, small, multiple sectors, country-specific or international, there are just so many options. I would suggest that as a stock market beginner, you invest into a bigger company that's more stable and a good track record, in a sector that you're interested in or you work in, or have a better understanding of. If you're not quite ready to make those decisions yet, you could put your money into index funds, which is a big basket of stocks that creates the diversification for you. This is a really good way for you to get some skin in the game, to monitor the performances, to try and figure out what's contributing where and when, and for you to learn a bit more about the stock market. Once you gain some more experience and knowledge, you can move out of your comfort zone and have conviction in making your own calls. But the most important thing to remember is the stock market is not a get-rich-quick scheme. Compounding growth takes time, and this is where the real money is made and true stable wealth is created. I really hope this has been helpful for you. And the next video in the boring but successful series is understanding the power of compounding. Make sure to like, comment, and subscribe if you want to grow your wealth and join our community. Have a great day and stay money-minded.